The S&P 500 is again nearing its 52-week low. Red-hot inflation has continued, and many analysts are currently predicting the short-term market pain to continue. While downturns in the market can be a frightening event for most, as a value dividend investor, downturns in the market are simply viewed as opportunities to buy great companies at discounted prices. In this video, I'm going to be discussing 3 stocks that I just recently added to my dividend portfolio. If you'd like to be able to download the spreadsheet used in this video to analyze the stocks, then you can head over to my Patreon page at the link in the description. If you'd like to keep up with my dividend investing journey, then be sure to subscribe as I release monthly dividend portfolio updates. Now let's go ahead and jump into the video. And the first company that I have been buying shares of is Texas Instruments, stock ticker TXN, currently trading $166.25 per share. This is a company I've been watching for a while. We can see year to date, they're down almost 13%. Now they recently released some pretty positive news. We can see they increased the amount they're going to pay in dividends by 8%, and they also authorized a $15 billion stock buyback. So both of those things are really good news if you are interested in this company. Now let's go ahead and jump into our stock valuation spreadsheet, where we're going to look at 4 different valuation models: grams, discounted cash flow, multiples, and dividend discount model. But let's go ahead and look on our stock screener here. We'll come up here and we're going to plug in the stock ticker for Texas Instruments and hit enter, and you can see all of this data is going to automatically load in. If we come over here and look at the dividend data, you can see it says they're currently paying out $4.60 per share. Of course, they are having the dividend increase, so it's going to be about $4.96 per share, which will give them a 3% dividend yield once that data is updated. Now, the payout ratio is currently sitting at a little bit below 50%. It's a little bit higher than I typically like to see, but not necessarily a red flag. And we can see they have a beta of 1.03, so their volatility levels are going to be pretty close to that of the market. But let's go ahead and jump into our first valuation model, and that's going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham in order to calculate intrinsic value. And here's the formula he laid out for us right here. So if we plug all of this in, we can see earnings per share of $9.14. We apply our growth rate projection. I pulled this from analysts and industry expectations. And then we plug in Y, which is the current yield of AAA corporate bonds. And at the time of this video, that's sitting at 4.48, which is about the highest it's been all year, which is going to lead to a lower valuation. But you can see once we plugged all of this in, we come to an intrinsic value of $152 per share, which is slightly below the current price. But keep in mind, if this current yield on AAA corporate bonds goes back to as low as it was earlier this year at 2.8, you can see this intrinsic value is going to shoot up to $244 per share. But let's go ahead and move it back and move on to our next valuation model, which is going to be our discounted cash flow model. Obviously a really important valuation, and in order to perform a discounted cash flow, we need to project a growth rate to the future free cash flows of the company. So to do this, I plugged in the historical free cash flows right here so we can see our year-over-year free cash flow growth rates, and they've been pretty solid. They've had an average growth rate year over year of 10.09%. So I'm applying a growth rate of 10% moving forward to the future free cash flows and the terminal value, which is the sum of the future free cash flows past the year 2030. I then took the present value of those future free cash flows right here and added them together, added the company's cash and cash equivalents, and subtracted out their total debt to find their equity value. Once I had the equity value, I divided by the shares outstanding to come to a discounted cash flow price per share of $195. Now let's go ahead and move on and look at our multiples valuation. And essentially what our multiples valuation is doing is it's taking companies that are similar to Texas Instruments, and it's seeing how the market values them using a price to earnings multiple. So what we're doing is, you can see the 3 companies we're using here. We're taking their stock price, dividing by the earnings per share to find their price to earnings multiple. We then take the average price to earnings multiple for these companies, which is 18.6, and we multiply it by Texas Instruments earnings per share, which is 9.14. which gives us an intrinsic value of $170 per share. Now let's go ahead and move on to our last valuation model, and that's going to be our dividend discount model. And this is one of my favorite ways to value dividend paying stocks, because it values them based on how much they pay out in dividends and how much that dividend is increasing. So you can see here I plugged in how much they're paying out each quarter in dividends, so we can see their yearly dividend payouts, and this allows us to see the year-over-year dividend growth. It's been really solid over the past few years: 16.8, 13.3, 12.7, and then 7.8, which gives them a year-over-year average growth rate of 12.7. Now moving forward, I'm applying I'm applying a growth rate of 6.5, which is a pretty solid growth rate for their dividends moving forward. After applying a discount rate of 9%, we come to a dividend discount model price per share of $211. Now let's go ahead and look at our output tab. And here on the output tab, we're going to see all 4 of our valuation models. We have grams at 152, multiples at 170, discounted cash flow at 195, and dividend discount model at 211. When we average all 4 of these together, we come to an intrinsic value of $182 per share. Now, as a value dividend investor, we do always apply a margin of safety. So let's say we apply a small margin of safety of 10%. We can see based off of this, our acceptable buy price for this company is $164 per share. Now, it's not quite there. The current price isn't quite there, but it's very close. But as for me, this is such a quality company. I've been wanting to add them for a while. I think there's a lot of positive news coming out about them and lots of solid dividend growth. So I went ahead and added a few shares. If it does go any lower, I'll probably add a few more. But let's go ahead and move on and look at the next company that I have bought. The second company that I have bought shares of is Caterpillar, stock ticker CAT. This company is currently trading at $182.11 per share, and like most stocks year to date, they're down about 12%. But let's go ahead and jump into our stock screener. We'll come up here and plug in their stock ticker CAT and hit enter. Let's go ahead and come over here and look at this dividend data. We can see they're paying out $4.80 per share, which gives them a dividend yield of about 2.64%, but they have a really nice low payout ratio. Now, the 20, 50, and 200-day moving averages are all currently down, but analysts currently have a target price of about $209 to $210 per share, and again, beta of 1.03, so the volatility levels are going to be pretty close to that of the market. But let's go ahead and look at grams valuation. I've already explained how this works, so we'll move through this a little bit more quickly. But you can see essentially pretty solid earnings per share for the company, a solid growth rate as well. But again, that current yield of AAA corporate bonds is going to drive this valuation down a little bit lower. But regardless, we still have an intrinsic value of $233, which is quite a bit higher than that current trading price. Let's go ahead and move on to our discounted cash flow model now. And you can see I'm applying a 12% growth rate to the future free cash flows of this company. So after we add all of the future free cash flows together in the cash and subtract the total debt, we can see our equity value right here. After dividing by the shares outstanding, we come to a discounted cash flow price per share of about $270 per share. So that is a very strong valuation based off of our discounted cash flow in comparison to the current trading price for this company. Now let's go ahead and move on to our multiples valuation. And you can see the companies I'm using as the comparables right here. We're taking companies like Deere & Company, AGCO, and PCAR. Take the stock price and divide by the earnings per share to find their price to earnings multiple. Once we take the average price to earnings multiple, we can see it comes out to about 14. And once we multiply that by our earnings per share for CAT, we come to an intrinsic value of $171 per share. Now let's go ahead and look at our last valuation again, one of my favorites for this scenario, and that's the dividend discount model. We can see our year-over-year dividend growth rate right here. They had a year a few years ago with almost 20% dividend growth. That's pretty unbelievable. They had a year where it didn't really grow any, then 7.7% and 8.11%. So overall, pretty solid dividend growth. We can see it gives it a year-over-year average growth rate of right at 9%. So that's very solid. I think moving forward, they're going to be able to have a very high growth rate for two different reasons. And if we jump back over to our stock screener, again, I mentioned this earlier, but they have a really nice low payout ratio, so they have plenty of room to continue to increase the amount they pay in dividends. And if we look at our discounted cash flow, we're applying a 12% growth rate to the future free cash flows. So they're going to have plenty of free cash flow to continue to increase their dividends. And this is one of the reasons I think this will be a really solid dividend growth company moving forward, and they'll have a high dividend growth rate. So once we apply our discount rate of 9%, we come to a dividend discount model price per share of $294. Let's go ahead and jump over to our output tab, and we can see all four of our valuations, and when we average them together, we come to an intrinsic value of $242 per share. Now, I applied a margin of safety of 20% right here, and we can see based off of this, our acceptable buy price is $193 per share, meaning now is a good time to buy that based off of our intrinsic value and our margin of safety. So this is one of the reasons I bought this stock. I think it's trading at a great value, and I think the dividend growth we'll see in the future will be very, very good. So that's one of the reasons I added this company. But let's go ahead and move forward and look at the last stock that I have bought. And the final stock that I have bought is Lowe's, stock ticker LOW. This is a company that I've absolutely loved for multiple reasons lately. They're currently trading at $195.10 per share, and year to date, they've taken quite a bit of a decline. You can see almost 24%. Let's go ahead and jump into our valuation spreadsheet. We'll come up here and plug in the stock ticker for Lowe's and hit enter. And this data will load in, and you can see they currently have a dividend yield of about 2.15%. That's not super high, but it actually is a little bit higher than it has been in the past. But look at this payout ratio, very low. So that's going to give them the ability to have really good dividend growth in the future. Now, again, we can see their 20, 50, and 200-day moving averages all down at the moment. Analysts currently have a price target of $246 per share, and their beta is sitting at 1.22. But let's go ahead and look at our valuation models. And if we jump over to Graham's valuation, let me go ahead and zoom in right here. But we can see there's multiple things to like about this company when we look at Graham's valuation. Really nice earnings per share right here at 12.68 and pretty solid growth rate projections. Let's go ahead and plug in Y, which is our current yield of AAA corporate bonds at 4.48 and hit enter. And that gives us an intrinsic value of $236 per share, a bit higher than that current trading price of $195. Let's go ahead and move on to our discounted cash flow model. And you can see I'm applying a growth rate of 10% to the future free cash flows for this company. And you can see if we look at the historical free cash flow, it's been a little bit choppy. It's been very up and down, but I think that'll start to smooth out in the coming years. I think a 10% growth rate is going to be pretty close to what they're at. Now, once we come to our discounted cash flow price per share after applying everything else, we come to an intrinsic value of $261 per share, quite a bit higher than that current trading price. Let's go ahead and move on to our multiples valuation. And you can see the companies here that I'm using for the comparisons. But once we take their average price to earnings multiple of 18.62 and multiply it by Lowe's earnings per share of 12.68, we come to an intrinsic value of $224 per share. So again, what exactly does that mean? Well, if we look at this average price to earnings for their competitors of 18.6 and jump over to our stock screener, we can see Lowe's price to earnings is sitting at just 15.38. So that may be a sign that they're undervalued by the market. Now let's look at our last valuation model, again, the dividend discount model. And this is where I absolutely love Lowe's, because if we look at this year over year dividend growth, we can see they have 17%, 14.6%, 9%, and then a massive dividend increase recently of 33.3%. That is absolutely unbelievable. That gives them a year over year average growth rate of 18.52%. Now moving forward, I'm applying a growth rate of 7.75%. And keep in mind, anytime you see a high growth rate, there's a couple of different things you want to check. We have mentioned them already, but you want to see strong growing free cash flow, which we have, and then you want to see a nice low payout ratio, which Lowe's does have as well at 18.9%. So that checks the box. They can have a sustainable high growth rate. After applying a discount rate of 9%, we come to a dividend discount model price per share of $275 per share. Now let's go ahead and jump over to our output tab. And you can see on our output tab, all four of our valuation models are going to provide a higher intrinsic value than the current trading price. And that's because there's a lot to like from this company. Really solid earnings per share, solid growth estimates, solid free cash flow growth, and really good dividend growth. And so when we average all four of these together, we come to an intrinsic value of almost $250 per share. So let's say we apply a 20% margin of safety. Based off of this, our acceptable buy price is right under $200 per share at $199, meaning now is a good time to be buying the stock. As for me, I was able to buy a few shares at a price of $190, so I'm happy with that, but I'd love for it to go lower so I could add more shares and get it at a better dividend yield. But there you have it. Those are three companies that I have added to my dividend portfolio over the past few weeks. Go ahead and let me know what you think of these companies. And if you plan on buying or selling, just go ahead and let me know in the comments down below. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching. Please don't forget to like and subscribe to the channel.